Hey guys, welcome back to another episode. Today we're going to be talking about traditional IRAs or a Roth IRA. Like, which one should you choose? Give you a little bit of details on each one, some questions you should ask yourself. So I want to jump into this and talk about how traditional IRAs and Roth IRAs both offer tax advantaged growth of money, right? But they do it differently, right? So the contribution for both accounts for 2021 is 6,000, or if you're over 50, 7,000. So the biggest difference between the account types comes down to when you're going to pay taxes on the money, right? So with that in mind, there's some questions we want to ask ourselves, right? But the first one we want to ask ourselves is, do you think you'll be in a higher or lower bracket in retirement than you are now, right? So, you'll be forgiven if say like a bunch of people out there, like you really don't know the answer, right? Like it's not a big deal. Because how are you supposed to know how much money you're going to be making and what tax bracket you're going to be in 20, 30, 40 years down the road, right? But there's some conventional wisdom we can go by, right? So if you have reason to believe you'll be in a lower tax bracket in retirement than you are now, it's going to be wise to stick with a traditional IRA, right? In other words, that means you're going to pay taxes on the money later when your income rate tax will be lower. On the flip side of that, right, if you're just starting your career and there's a good chance you'll be in a higher tax bracket later in life, a Roth is probably going to be a better choice because you'll pay income tax at your current or lower tax rate, right? There's some other considerations to talk about too, right? If you're on a very tight budget and could really use a tax deduction now, a traditional IRA could be the way to go. There's some other questions to help you decide. We're going to get into them, right? So, like, I think my tax bracket will be higher in retirement, right? So, after you're done working, you retire, you think, in retirement, your tax bracket is going to be higher. Well, if you think your tax bracket is going to be higher in retirement than it is what you're currently making, you're going to probably lean towards the Roth IRA, right? But you got to ask yourselves, a couple questions to see if you qualify, right? So, of course, if you really want to open a Roth IRA but you aren't eligible to contribute because your income is too high, you can do a backdoor Roth maneuver, right? And that's, something for later, right? With a Roth IRA though, you pay tax now, right? You contribute to a Roth IRA using after tax money, and you can't deduct the contribution from your taxable income. But when you do withdraw the money in retirement, it's tax free. Roth IRA contributions are also subject to certain income limits. A single filer and head of household can make a full contribution if your income is below 125,000, right? And a partial contribution up to 140,000. For married filing jointly, you can make a full contribution if your income is less than 198,000 and a partial contribution up to 208,000. You can withdraw contributions you made to your Roth IRA anytime, right? Tax and penalty free. However, you may have to pay taxes and penalties if you withdraw the earnings in your Roth IRA prior to the age of 59 and a half. If you're 59 and a half or older, but haven't had the account for more than 5 years, your earnings could possibly be subject to taxes, but not penalties. Unlike a traditional IRA, though, you're not required to take withdrawals after age 72. So, like, what about if you think your tax bracket's going to be lower in retirement, right? If you think your tax bracket's probably going to be lower in retirement, then a traditional deductible IRA might serve you better. But there's some considerations with that too, right? So, with a traditional IRA, you pay taxes later. When you contribute to a traditional IRA, if your income is below certain limits, you may be eligible to deduct the contribution from your adjusted gross income, which means you won't pay tax on it now. Beginning at age 59 and a half, you can withdraw money from your traditional IRA. At that time, you will pay income taxes on the amount withdrawn. For single filers who are covered by a company retirement plan, you can deduct the full contribution if your modified adjusted gross income or your, MAGI or MAGI is below 66,000, and a partial deduction up to 76,000, 105,000, and 125,000 for married filed jointly, right? So, if neither you nor your spouse is covered by an employer sponsored retirement plan, you are eligible to take the full deduction. If you withdraw the money before you turn 59 and a half, you may be subject to a 10% penalty on the withdrawal. Beginning at the age of 17, you will be required to take taxable withdrawals from your account, or you will be subject to a penalty. Okay, well, the last question is going to be, do you have any idea what your tax bracket is going to be in retire? Well, of course I don't. I have no idea. Well, if you don't know what the future holds, which, I would say a good amount, if not most people fall into that category, right? It's a pretty good idea to say split the difference, right? Contribute to both account types if you can. If you do, you'll have the freedom to choose whether you pay taxes on your income and retire or not. I'm only giving this piece of information as more of a, some people who are afraid to go one way or the other, like, might want to just go, halvesies on it. However, while I am giving you this information, I don't recommend it, right? I just want you to know it's something that you can do. Personally, I'm only like 5 years into my career. So for me, like, a Roth IRA is definitely the way to go. Actually, I have a Roth 401k through my employer with employee matching. Um, I also, I just started it not too long ago, so it's, it doesn't have much in it. But for me, I know that since I'm in the early part of my career, I know my money's going to go up every year. And I also know that every time I get a raise, I'm going to put more and more of the money into my account until it's maxed out. And then when it's maxed out, anything over that, it's just gravy, right? So I have a thing right here on the screen for everyone to look at. So with a Roth and a traditional, if you contribute 10,000 to both, you pay upfront taxes on the Roth, right? So 2,500, and you pay no upfront taxes on the traditional, right? So you invest 7,000. It ends up being 7,500 invested in a Roth, and $10,000 invested in a traditional. After 30 years, at 10% interest, which, if I'm being honest, is a little high. 7 to 8% is a little more conservative. 148,780 versus 198,734. Well, in a traditional, when you start pulling that money out, like, let's say you're 72 years old, right? And the Roth, we pull that money out, you don't have to pay that income tax, and you have $148,000. Well, on the traditional, when you take that money out, it becomes taxable income. You get that 25% income tax on it, and it ends up being really close to the same amount of money. If, this example is exactly the same, but, it's going to be really, really close to the same, right? So it just goes to show you, like, it honestly depends on what tax bracket you're going to be on. Because if later in life you're, let's say you're in a tax bracket where instead of 25%, it's 30%, then the traditional you end up having less money than the Roth. That's why, you want to make sure that if you're going to make more and more money, you probably want to start a Roth. If it's not going to really go up, it's going to stay about the same, maybe go down a little bit, traditional is the way to go. So I hope you guys got some good information out of this video, and I hope it was a good watch. If you guys wouldn't mind, go ahead, like and subscribe. And until I see you guys in the next video, y'all be good.